Good morning, good afternoon, or good evening. No matter the time of day or where you're joining us from, we thank you for being here. I'm Steve Henning, and this is the CVB Network podcast, where we cover a variety of topics, but all related to the commercial vehicle ecosystem. Today, I'm really excited about our guest, and I don't normally do this, but I'm going to read a little bit about his background because it's just so darn impressive. So bear with me if you would. But this gentleman has many, many years in the automotive industry. He's managed and owned car dealerships, for example. For several years, he was the director of custom curriculum at the National Automobile Dealers Association, and he spent time managing and operating truck dealerships as well. Today, he's an instructor, consultant, and curriculum specialist with Training Team USA, where he works extensively with commercial vehicle and heavy truck industries. His name is Gil Weiss. Gil, welcome to the show.
Thank you, Steve.
So happy you agreed to spend a few minutes with us. I really appreciate it. I think today's topic is going to be very relevant, and I think it's maybe a little bit misunderstood, and that topic is Section 179. So maybe we'll start with this, if you could. Could you give us just an explanation of Section 179, what it is, maybe kind of put it in layman's terms so people like me can understand it?
Okay. I'll take one step back from that and say that the government only gives businesses gifts, only so many and only so often. But this one truly is. And it builds on the original gift, which is unlike a W-2 employee of a company, the company itself has the ability to reduce their taxable income by writing off. We hear a lot about write-offs, right? And writing off the investments they make in equipment. And fortunately for us, trucks fall under the definition of equipment based on the IRS tax codes. So a company can buy a vehicle and they can take the depreciation on that vehicle every year as a reduction on their taxes. So that's already pretty good news. And when they do it, it's actually a accelerated depreciation, meaning they don't base it on, well, this year make model truck with this upfit has this auction value, and the market's strong this year, the market's weak this year. It's not based on any of that. It's a simplistic formula they use that actually lets the vehicle depreciate faster than it actually does in real life. So it's very generous to the business owner. So, and it's very, very simple. So there's no debate about, well, what's it worth this year and how much value did it use? So that's nice and clean. What they do is they cap it at 5 years. You can write it off for 5 years. Now, in real life, it continues to depreciate the next 5 years and the next 5 years if you can make it last that long. But the government says 5 years. Well, a lot of times when we know the reason behind something, it makes more sense. The reason behind it is the government wants people to spend money. They want businesses to spend money. They want businesses to spend money with truck dealers, and the truck dealers order more from their manufacturers. It kind of keeps the wheels of the economy lubricated and moving. And then, of course, in turn, those manufacturers and those dealerships, they spend money to upgrade their facilities and hire more people and so on. And all of it fuels the economy. With Section 179, it's a gift on top of a gift. It allows a company to take that 5-year depreciation benefit that saves the money on their taxes each year, and it allows them to take all 5 years worth on the year the vehicle's purchased. Now, they're very specific about what that means. It has to be in operation during the tax year. But companies all the time will buy a lot of vehicles in the last quarter of the year, particularly the last month of the year, all the way up until sometimes New Year's Eve. And as long as they go through the business office and they have contracts that are dated on the last day of the year, in theory, the vehicle is working that day. Whether it actually does or not, it's close enough. And so they can they can spend that money at the very end of the year or any time up until that point, and they can claim the next 5 years of deductions on the tax year that, for all practical purposes, is over, right? Because if we're buying it at the end. And so that's pretty desirable, because if a company is, let's say, in a 30% tax brackets. Companies pay more taxes than we think they do. And if they're in a 30% tax bracket, and I always like to use the example of the $100,000 truck, that used to be a stretch. Now it's maybe on the light side these days, if it's got any kind of an upfit at all on it. And so you take $100,000, they can take that $100,000 and reduce their taxable income by that $100,000, which means $100,000 that they would have paid $30,000 worth of tax on had they not bought the truck. Now they get to reduce their tax bill by $30,000 in that example, more or less, depending what tax bracket in, more or less, depending on the price of the truck. And they can do it with multiple trucks. So that's a great deal. And so it's a wonderful thing. And truck dealers already do pretty well at the end of the year, even if it weren't for Section 179, because the year we're in, 2025, whether it's the day we're doing this recording or whether it's December of 2025, that gets to be the first year, and then they can take that depreciation for additional years. But with Section 179, they get all 5 years in next tax year, even though the truck didn't even get dirty until after New Year's Day. Now, that sounds like kind of a no-brainer. Well, why wouldn't companies want to use Section 179 all the time? But that's not necessarily the best thing to do. It depends on how well the company is doing in a given year. Suppose they're having a banner record year. Well, that's a good thing. Well, the bad part is they will pay more taxes than they have ever paid in the company's history. It makes it a really good time to buy trucks and other equipment. And it also makes it a really good time to use Section 179 to try to tamp down their tax burden and mitigate some of those taxes. But that cycle goes up and down. What if they had a particular lean year, but they also need to replace some trucks? It may make more sense to spread that over 5 years, because if it's a small company and that one truck is a pretty big part of what they do, they may not have over $30,000 in, after all their other deductions, to write off. So let's say they only got to use half of it. They only got to use $15,000 of that $30,000 benefit. The other $15,000 just goes to waste, and they can never reclaim it. They can't roll it forward. So companies have to be really careful, especially on multiple truck purchases. Let's make sure we have plenty of income to use this against. And usually that's not a problem, but for smaller companies, it can be. And so there's benefits to that as well. The downside of using Section 179 is then you forfeited all of your write-offs in those future years. What if business got better every single year? Each year you would need that benefit more, and it wouldn't be there because you've already burned through it.
A lot to consider there, but boy, what you say makes a lot of sense. It's funny. You mentioned dealers frequently being pretty busy, commercial vehicle dealers specifically, in the last quarter. I can tell you in just recent conversations, and we're recording this at the beginning essentially of Q4, in recent conversations with dealers that I've spoken with, they've all more or less told me, man, if I was any busier, I'd be a twin because I'd need so much more help. So yeah. I'd say your statement there is very accurate. I'm going to come back to another question, but since you mentioned this, you talked about businesses wanting to consider whether or not they want to capitalize on Section 179 in a given year. What would your advice be to a dealer in terms of a conversation with their B2B customers, their commercial customers? What kind of questions would you suggest they ask to ensure that they're helping their customers with their business and with their cash flow, so to speak?
Well, what I would do is I wouldn't just, first of all, we're never going to give out tax advice, but we can share facts, right? Facts are okay to share. And truck people always know to tell the business owner to, run it past their accountant, of course. But I would have this conversation every month of the year. I wouldn't wait till the last quarter like most people do. I would be talking about this all the time because, well, let's get back to the concept that the government gave us this gift, right? Well, that means that the gift giving ends at 5 years. And a lot of times companies try to save money by driving their trucks till they drop. They would be better off to cycle those trucks at 5 years. Now, here's the remarkable thing, right? Sometimes when we think about paying taxes, we think of the IRS being greedy. Well, in this case, they're actually not. So let's say you and I each have a company, Steve, and you buy this truck and you're going to use it for 5 years, and you're going to get that 5 years worth of benefit, whether you take it all at once as a Section 179 or you take it over the 5 years. That, of course, would be your choice. You're done with the truck. You say, wow, I really enjoyed the government helping me pay for this truck. And now they're going to stop. I'm going to get another truck, even though this truck's perfectly good. But because it's perfectly good, it's also worth a lot of money. Trucks hold their value really well because nobody's worried about a little nick or a scratch or a little snag in the upholstery. And so trucks really bring good money. Now, I'm a company and I need the same kind of truck you do. So I buy that truck from you or the dealer you traded it into, and I get to depreciate that truck for 5 years, even though it's used. Now, what you can't do is track lease it or conventional lease it and then turn around and buy it and depreciate it twice. They're very specific. A company can only depreciate a truck one time. A different company can depreciate it all over again. And if you could make it last 15 years, I suppose you could do it again. Chances are there's not much left after 10. But so that's a really interesting thing. So the way I would use that information during the year as a truck account manager is I would coach my clients that, look, let's do a fleet analysis. A lot of these trucks have passed that 5 year mark. We already know they cost more to keep on the road. You know, we're going to keep them 6 more months, and that's another set of tires because we're at that threshold, another set of brakes, and other repairs that tend to happen later in the vehicle's life. Let's get those trucks out of the fleet now. That'll save money. And let's start that cycle over again with the government paying us in the example we used, $30,000 towards that $100,000 truck. And so, and whether you take it all at one time or later or not. And the way I would use Section 179, I'd really rather they spread it over 5 years, because I want them to remember that they're getting that benefit each year so that I can sell them trucks along the way each year. And then what happens is they get towards the end of the year and I've got a fleet that hasn't quite pulled the trigger. They're dragging their feet. That's when I would maybe shine a brighter light on Section 179. Look, you do this month. Let's say it's December. I've got a truck in stock. It's got the body on it. It's exactly the truck you need. Let's do this now. Let's pull the trigger. And, you know, if you've had a big year, and you're right, a lot of companies, the reason truck guys are busy is because companies are having good years. And so, which has been the case for the last several. So that's how I would use it.
That makes sense. And a couple of things I'd just like to reiterate that you said. So first of all, most dealerships are pretty doggone smart, is advise your customer or your client, not a tax professional. You should consult with that person. But you also said, let's do a fleet analysis. Really good advice, right? Let's look at each individual situation because they're all different. And what might apply for your business may not apply to my business or vice versa. So let's look at it and figure out what makes the most sense for your business. And that's one of the things I really enjoy about the commercial space in general is it's built on relationships and it's built on partnerships. It's not so much a salesperson customer. It's more of I'm a commercial account manager and my job is to help you deal with your business and make sure I'm giving you the best advice I can and the best help I can. Yes, I want to sell vehicles. That's how I make my money and my livelihood, but it needs to be good for both of us. And that's, I think, a big part of what you just said, at least that's what I heard, is look at the individual situation and then advise from there, with the caveat of not a tax professional. You should speak with your accountant when it comes to that.
Right.
So I like all that advice. Now, one of the things I heard about Section 179 specifically was there was some changes that took place this year compared to years prior. Current administration, I think, maybe changed some things. Can you speak to that a little bit and just share what did change?
Okay. So here's what they did is they had a major piece of legislation earlier this year, and a lot of these laws, like this one in particular, went into effect in July. I want to say it was July 25th, but that date's not that important. What matters is it went into effect because it's retroactive for vehicles they purchased all the way back. You would think January 1st, but it's like January 11th. It's some random, I don't know how they come up with this, but chances are they didn't buy any trucks the first 10 days of the year. It's usually a pretty sleepy time of the year for truck purchases. And so the beauty of it is they can buy that truck in January, and they have until tax time next year to decide whether they're going to do Section 179 or whether they're going to spread it out. So we don't have to know that as a condition of sale or at the time of the contract. That comes after the fact. It's reactionary. So that's one thing. The other thing that changed is the amounts went up. It went up to like $2.5 million. Now, there's no one truck that costs $2.5 million, of course, but it means that they don't have to say, well, I'll buy 2 this year and 2 next. No, they can buy as many as they want. The big national account fleets are not the ones that the truck sales agent is usually calling on. So they may run out, but our local accounts are not going to. So that was one good thing. And starting with 2026, it's going to become a permanent part of the tax code. When Section 179 first came out, and gosh, I've lost track of time. It's been 10 or 15 or 20 years ago. It's been a while. And it came out as kind of like a 1-year program to stimulate the economy, because the economy at that time needed stimulating. And then next year they said, well, let's stimulate it some more. And it ended up never really quite going away, but each year it could have. Starting 2026, it is now a permanent part of the tax code. So it doesn't matter how many more presidents we have every 4-year cycle, this is going to be permanent. Congress would have to take very, very specific action to make it go away. And I don't know. I don't think there's anybody really against it. It's one of the few things that isn't politically polarizing, right? Because everybody wants business to do well. Everybody wants the economy to do well. And the thing about it is, we're not giving companies more money. We're just giving it to them sooner, right? So even if Section 179 goes away, a company would still have all the same deductions. The IRS doesn't spend more or spend less because they're not really giving us money. We're just paying them our tax money spread over 5 years instead of the other way. So those are some things that changed. And then there's a thing called bonus depreciation. If you run out of the $2.5 million, I don't think any of our customers are going to, then there's another way to override it. And then I think it's like 80% or something they can do. And the other 20% would be, divvied out over 5 years. But I never even talk about that because it's already such a generous amount. It just doesn't affect, our volume size customers.
Yeah, so, 2.5 million's a big number.
Yeah,
for most businesses, at least, for sure.
Yes, and sometimes companies well, I should do it this year. It may not be there next year. Well, that's not a concern anymore. It's now a permanent part of the IRS tax code, which I think businesses like certainty. They like things to, they like to be able to know how it's going to be. And this is a case where they're going to know how it's going to be.
We could have a whole other discussion on certainty right now and things that are changing, but we won't go down that path today, Gil.
And we would still be uncertain.
That's exactly right. Well, that's some really good information. Any final thoughts from a dealership perspective, right? They're in the business of selling vehicles for sure, but also helping their customers. Any final thoughts there that you say, take these couple of tidbits away from the conversation?
Make sure that it's an eligible vehicle. It has to be not less than 6,000 pounds gross vehicle weight rating, which would cover a standard payload full-size pickup truck and up, like an F-150, Silverado 1500, Ram 1500, a Tundra, that kind of vehicle. It would cover all of those and up. When you get to the smaller vehicles like a Ford Maverick, it's not going to be 6,000 pound gross vehicle weight rating. They can still spread it over 5 years. They just can't do a Section 179 on that. But you can do a
That's
section 179 on amazing things. I did it on a conference table and chairs because it's business equipment, right? You can do it on computers. So that type of thing. You can deduct money on software, but you can't section 179 software. But again, we're getting down in the weeds, so truck people are not going to need to know that. So other than making sure it's an eligible vehicle, that's the only place. Cars generally do not qualify and for 179. And with trucks, you have to be a little careful because if it's an SUV, right, you got a Cadillac Escalade the business owner wants to drive around in, there's still some deduction on that, but they cap it at a certain dollar amount. It can't cost $100,000. It can cost $100,000, but maybe they cap it at a lower amount. But if it's a truck with a cargo box of at least 6 feet or a van with an interior stowage of 6 feet, that falls into the category where it's 100%. You could have a really expensive outfit. Sometimes we have those outfits that cost 5 times as much as the chassis, right? And you can, the sky's really the limit until you run out of your $2.5 million, and you're probably not going to do that. So that's one thing I would caution. If you get the dentist, the attorney that is not a W-2 employee, they're their own business a lot of times, unless they work for somebody, and they want to go by it. In the early days, they didn't have that exclusion, and people were buying, some of those, like the Mercedes SUV when it first came out, that ML, whatever it was back then. It squeaked across that 6,000 pound gross vehicle like by 20 pounds. And so all these professionals with those consulting type businesses were buying them, and they closed that loophole up a little bit when they started going to a little bit deeper in the weeds. But there's all kinds of stuff online, in particularly now, just because of the law change. There is so much stuff that you can read and self-study on. But I think we've covered a lot of the best points. Did you have some other questions you wanted me to speak with?
I would say you've answered most of them, and that's why I asked if you had any, tidbits that we need to consider. I certainly like the advice of make sure the vehicle qualifies, because the last thing you want to do is set somebody up for failure. That's the way to sour a relationship really quick.
Right. If it's a truck only dealer, probably every single thing they sell qualifies, right?
Yeah.
Because a small truck at their dealership is a big truck at like a Chevy or a Ford or a Ram store, right? So it's the truck dealers that also are in the car business that have to be careful, because they've got some of those smaller vehicles that may not qualify. So they qualify from the standpoint of writing it off normally, but they don't qualify for Section 179 where they claim all that tax benefit up front.
Makes sense. In fact, you beat me to it when you talked about the conference table. My question was going to be, was it over 6,000 pounds? But I guess that doesn't apply to conference.
No, that's only on vehicles. That's right. Yeah. So, and even then you have to be a little careful, because I didn't realize I subjected myself to a local tax. So in hindsight, I wouldn't even have done it. So.
Well, Gil, I appreciate all the insight. I know the audience does as well. You've got a lot more knowledge than anybody else I know on this topic. So thanks so much for sharing that. Hopefully we can, give a little good advice to our audience and help them help their customers. That's really what it's all about.
And today in this brief broadcast, it's just enough to get started. I would definitely go online and I would even see sometimes your body companies that do a good job with giving you a printout that takes the tax code, just like an encyclopedia, and brings it down to a one pager that describes it from the perspective of somebody buying a truck. And it takes all that other equipment definitions and all that out of it, and it really simplifies it. And they even give some examples and so forth. And some of the websites, you can even plug in your amounts and it'll calculate for you too.
So hopefully this is the springboard, and then people go do some self-study, a little more research, and get more knowledge on it. Sounds like the best route to take.
And if they get them to the 5 years and get them to start cycling those trucks at 5 years, that's how long financing usually is on commercial vehicles, even though consumer vehicles go much longer. That's also when extended service contracts and maintenance contracts expire at 5 years. Roadside assistance, 5 years. And so with everything expiring at 5 years, if they cycle at 5 years, they're actually more likely to buy those products, because why would you, if you're going to keep it 10 years, why would you insure during the first 5 years when it breaks the lease and have to self-insure the second 5 years. So their penetration on selling those other services would go through the roof once they get their companies educated to go 5 years. And by the way, all the big fleets cycle at 5 years or a lot less.
Yeah, they've done the ROI calculations on that,
They
I
have.
suspect.
That's right. So,
Well, excellent. Thanks so much, Gil. Really enjoyed the conversation and appreciate all the insight you provided.
likewise. Thanks for the invite. Appreciate it very much.